Hey guys, welcome back to the Capital Mindset Show. So today we're going to try to start kind of like a new series, and I'll see how often I can do these, but we're going to be covering the actual earnings report of the Honest Company, which, you know, it's decently covered, and I thought it killed two birds with one stone. So basically, this video will be to the extent of the earnings call reaction, and which I will be entirely silent throughout the earnings call. We will listen to it together. I might pause it to make a comment here and there. If you guys want to, you guys can just skip over or pass this part. So I'm going to hopefully put in a chapter. I should be able to do that easily. And I will also be looking over their earnings report, their 10Q. And so, you know, I'll be making some commentary there. You might see me in the backdrop. I might be moving stuff around. So, you know, regarding the actual presentation, well, not the presentation, but the 10Q, I'll be looking through it. And towards the end, we'll do kind of like a final thoughts on how they did and what we kind of look for today. So before we begin, I'm actually going to show the price action of today. And we can see here on the 1 day, they are up 10.92%. So supposedly the earnings are good. At the time of filming this video, it is about 3:16 p.m. Eastern Standard Time. So with that being said, or without further ado, we shall begin. So let's press play.
For standing by, and welcome to the Honest Company's first quarter 2022 earnings call. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question and answer session. Please be advised that today's conference is being recorded. I would now like to hand the conference over to Mr. Steve Austenfeld, VP Investor Relations at the Honest Company.
Great, thank you. Good afternoon, everyone, and thank you for joining our first quarter 2022 conference call. Joining me today are Nick Vlahos, our Chief Executive Officer, and Kelly Kennedy, our Chief Financial Officer. Before we start, I'd like to remind you that we will make certain statements today that are forward-looking within the meaning of the federal securities laws, including statements about the outlook of our business and other matters referenced in our earnings release issued today. These forward-looking statements involve a number of risks and uncertainties that could cause actual results to differ materially. Please refer to our earnings release issued today, as well as our SEC filings for a more detailed description of the risk factors that may affect our results. Please also note that these forward-looking statements reflect our opinions only as of the date of this call. We undertake no obligation to revise or publicly release the results of any revision to these forward-looking statements in light of new information or future events, except as required by law. Also, during this call, we will discuss certain non-GAAP financial measures which adjust our GAAP results to eliminate the impact of certain items. You'll find additional information regarding these non-GAAP financial measures and a reconciliation of these non-GAAP to GAAP measures in the financial results section of today's earnings release. In addition, a live broadcast of this call is also available on the Investor Relations section of our website at investors.honest.com. With that, I'll turn the call over to Nick.
Thanks, Steve. Good afternoon, everyone, and thanks for joining us today. As noted in today's earnings release, our first quarter results were in line with the outlook we provided in our last earnings call. As we highlighted in that call, first quarter revenue was impacted by unfavorable sales comparisons, as well as consumer channel shifts that resulted in a year-over-year decline in revenue for the quarter. Over the last 4 quarters, our core category revenue was up 6% versus prior year, a solid comp over COVID-driven demand in the year-ago period. As we look to the balance of the year, we're excited to share that we're on track for delivering new product innovation and expanding our retail footprint to build a solid foundation for future growth. Despite unprecedented volatility and macro environment challenges, I'm pleased we were able to maintain our financial outlook for the year. Today, we are reaffirming our full-year outlook with mid-single-digit growth over the remainder of the year as we gain distribution with new strategic retail partners, launch new margin-accretive products, and continue to invest in our digital capabilities. I'd like to start by sharing some thoughts on the macro challenges the industry is currently facing, starting with inflation. Costs affecting every part of the P&L are rising, impacting product, logistics, warehousing, labor, and administrative costs. In response, we remain in close contact with our suppliers and partners to understand and address any potential cost impacts. Additionally, to help mitigate inflationary pressures, we've executed mid to high single-digit price increases on our product portfolio. While it is still early, an initial read of our first round of pricing is in line with our expectations. We have seen a modest decline in volume, but over time, we expect velocities to rebound. As indicated by tracked data sources, the demand from consumers looking for clean, natural solutions remains strong despite higher shelf prices. We expect to mostly offset the current inflationary impact in 2022 through these pricing actions, supported by cost savings and favorable mix. If we see further input cost escalation, we believe we can take additional pricing later in the year to preserve margins. Turning to supply chain. It's important to note that a majority of our products are manufactured in North America. Our diapers, which are nearly half of our portfolio, have seen limited supply chain issues. Our skin and personal care products, which represent roughly a third of the portfolio, have ingredients and packaging that are sourced internationally but are predominantly manufactured in North America. As a result, we've experienced some supply chain impacts in personal care and beauty. Our main exposure to global supply chain disruptions is with our baby wipes, which represent less than 20% of our revenue. Over the past 6 months, we've experienced intermittent out of stocks on key items due to COVID-related factory shutdowns and demand-driven ocean freight and port delays. We were predominantly back in stock in baby wipes by the end of the first quarter, but expect a continuation of supply chain constraints for the foreseeable future. During Q1, we invested to increase core inventory levels by roughly 10% to mitigate the impact of supply chain delays. We also want to address the impact of conflict in Ukraine on our business. Similar to most beauty brands, we source certain ingredients, specifically sunflower seed oil, for which Ukraine is a key producer. The conflict in Ukraine has disrupted supply or driven higher prices on these ingredients from that region and impacted the market for certain ingredients from other regions, like palm kernel oil. While this represents a risk, we believe we have supply assurance or alternate sources of supply to continue to meet consumer demand. Lastly, I'd like to reinforce that Honest remains in a healthy balance sheet position with no debt and sufficient cash available to fund our growth investments. As a result, we are not directly impacted by the rising interest rate environment. Now, turning to our core growth drivers, marketing, innovation, and retail distribution. Starting with marketing. We continue to invest at a high level in support of our brands, with marketing spend at 20% of sales in the first quarter. While that was down on a dollar basis versus a year ago, it's important to recognize we were supporting a significant launch, our Clean Conscious diaper, in the year-ago quarter. What's more important is that our high level of marketing support this quarter reflects our commitment to supporting our brand in 2 ways. First, as noted last quarter, rising digital marketing costs are leading us to shift traditional marketing investment more towards shopper marketing and other vehicles to reach consumers in store. This is a good example of our return-based approach to directing brand investment to where it will drive growth most cost effectively. Second, shifting dollars from marketing to in-store demand building activity supports the strong growth we see with key retail partners and aligns with our retail distribution expansion in the second half of the year. In short, Honest is a strong lifestyle brand that spans across multiple categories with a high degree of consumer loyalty, continued market share gains against conventional brands, and increasing household penetration, which grew to nearly 5% by the end of 2021. Turning to innovation. We have a robust innovation pipeline coming out in the second half of the year. In addition to a packaging refresh for our personal care line and training pants, we are launching a new concealer line. a suite of clean clearing skin products, an extension of our best-selling clean mascara, and expanding our supplements line. The new innovation is on track to ship across the second and third quarters. On the distribution front, our expansion in store with key strategic retail partners is on track to roll out in the second half of the year. We will be launching Honest diapers, wipes, and personal care on Walmart.com in early Q3, and then launching in Walmart stores across the country in the fourth quarter. Not only is Walmart the largest seller of diapers in the U.S., but their strength in the South and Southeast regions will significantly benefit Honest, as our ACV in those markets is underdeveloped, the lowest of all U.S. regions. We are also expanding distribution nationally at Ulta, which we will pivot from being solely online to launching in-store across the country. In addition, we're expanding our supplements line to add sleep, stress, immunity, and hair health. These will be available in-store and online at GNC and at honest.com. On the international front, we're pleased to announce that we have signed a partnership with Superordinary, a leading global brand accelerator, to launch our products in Asia in the back half of 2022 through a flagship store on Tmall. Superordinary has a proven track record for launching premier U.S. beauty brands into China. While management efforts will be focused on delivering our strategic growth initiatives in North America in the near term, we are pleased with this new partnership that will set the foundation for future global expansion. Overall, we're excited about our progress delivering marketing, innovation, and retail distribution initiatives that will drive growth for the remainder of 2022 and into 2023. I'll close by saying that despite a tough Q1, the Honest brand continues to resonate strongly with the consumer. We've significantly grown household penetration and brand awareness over the last 2 years, and our market share continues to increase. We maintain our conviction that Honest can be the new modern CPG brand while driving our mission to inspire everyone to love living consciously. Now, I will turn it over to our CFO, Kelly Kennedy.
Thank you, Nick, and welcome everyone. I'll start by saying that our first quarter results and 2022 outlook are consistent with what we shared with you during our last earnings call. Our Q1 results reflect difficult year-over-year comparisons that we do not expect to continue into the remainder of the year, as well as elevated cost pressures that impacted margins. Looking ahead, we continue to expect Honest to deliver mid-single-digit growth over the remaining 3 quarters of the year compared to 2021 as we introduce innovation, expand with strategic retail partners, and improve the digital experience on honest.com. While cost pressures are expected to remain elevated, we anticipate much of the margin impact will be offset by the benefit of recent pricing actions. Now, diving into the financials. Starting with our financial results and key drivers for the quarter. Revenue decreased 15% to $69 million for the first quarter of 2022 compared to the first quarter of 2021. The decrease in revenue for the quarter partially reflects a liquidation of legacy beauty inventory in the first quarter of 2021 ahead of last year's beauty restage, as well as a tough comparison against elevated sales in the year-ago period related to sanitizing and disinfecting products. Combined, these 2 items impacted revenue growth for the quarter by approximately 6 percentage points. The other key driver is the consumer shift from the digital to the retail channel. Given our high digital penetration, our revenue has been negatively impacted as consumers return to in-store shopping, as our ACV lags leading conventional brands, with Honest products only on roughly half of retail shelves in the U.S. As we expand our retail distribution later in the year, most notably our launch with Walmart, we anticipate significant ACV expansion, which will help to capture this consumer shift to retail and restore growth in the back of the year. Finally, first quarter revenue was also negatively impacted by out-of-stocks on several key items due to supply chain disruption and higher overall trade promotion levels due to a lower revenue base relative to the first quarter of 2021. Diving into key drivers by product category. First, diapers and wipes. Revenue from diapers and wipes represented 63% of total revenue, decreasing 13% in the first quarter of 2022 compared to the first quarter of 2021, driven by declining digital traffic and purchases. This category was also impacted by supply chain disruption, which led to out-of-stocks on our wipes business, resulting in an approximate low single-digit impact on the category. Skin and personal care. Skin and personal care represented 31% of total revenue and decreased 19% in the first quarter of 2022 compared to the first quarter of 2021. This reflected a $3 million liquidation sale in advance of our beauty restage in the first quarter of 2021, representing a 13-point impact on revenue for the category. The category was also impacted by a decrease in beauty product sales in our digital channel due to lower digital traffic and out-of-stocks on key items due to supply challenges. Household and wellness. Revenue from household and wellness represented 6% of total first quarter revenue and decreased 20% compared to the first quarter of 2021. The decrease was due to declining consumer demand for sanitization and disinfecting products versus the year-ago period. Now turning to results by channel. In the first quarter, our revenue was equally split between retail and digital. Digital revenue declined 19% year-over-year behind an industry-wide consumer shift from digital back to in-store shopping. Also, as the industry faced escalating costs of paid advertising, our ability to cost-effectively drive traffic to online platforms was negatively impacted, further eroding digital revenue. Retail revenue declined 11%, reflecting an approximate 12 percentage point impact due to prior year liquidation of legacy beauty inventory and a tough comparison against elevated sales in the year-ago period related to sanitizing and disinfecting products. Excluding these impacts, retail revenue was up slightly. As we've highlighted on our previous earnings call, we believe our omnichannel model is a competitive advantage, especially as the industry faces rapid and unprecedented shifts in shopping behavior. Given our balanced digital and retail business and upcoming distribution expansion, we are well positioned as we strive to be wherever our consumers choose to shop. Turning now to gross margin. Gross margin was 30% in the first quarter of 2022, compared to 35% in the first quarter of 2021, generally in line with our expectations. Lower sales revenue versus the year-ago quarter resulted in approximately 400 basis points of fixed cost deleverage. In addition, the decrease in gross margin reflected approximately 150 basis points of higher input, transportation, freight, and warehouse labor costs as compared to the first quarter of 2021, higher trade support of 150 basis points, and the adoption of the new lease accounting standard, which had an approximate 60 basis point impact. These factors were partially offset by the January price increases, which benefited gross margin by roughly 200 basis points, as well as the impact of 60 basis points from favorable product mix and cost savings. Operating expenses were up $3 million in the first quarter of 2022 compared to the first quarter of 2021, generally in line with expectations. Looking at the primary components, SG&A expense was higher versus prior year, reflecting costs of operating as a public company, including higher stock-based compensation and insurance expense. Marketing expense was down from the prior year when we were supporting the launch of our Clean Conscious diaper. However, advertising was still nearly 20% of sales in the quarter, and we continue to expect to spend at a mid-teens rate for the rest of the year on a growing revenue base. R&D expense increased as we continue to invest in growth to support new product launches and cost innovation. Now turning to the bottom line and the balance sheet. Adjusted EBITDA for the first quarter of 2022 was negative $10 million. We ended the first quarter with $78 million in cash equivalents, and short-term investments as we increased our inventory position to proactively manage longer supply chain lead times and delays. Looking forward, we expect our quarterly cash balance to range between $65 and $75 million for the balance of the year. Turning to our fiscal year 2022 outlook. As Nick highlighted, we are reaffirming our full year guidance, which is unchanged versus our last earnings release. Revenue is expected to be flat versus 2021, with the remaining 3 quarters growing at a mid-single digit rate. Our core categories, diapers and wipes and skin and personal care, are expected to grow slightly ahead of the company average, with household and wellness declining as we continue to face reduced consumer demand for disinfecting and sanitization products. Adjusted EBITDA is expected to be in the range of -$5 million to -$10 million for the year, reflecting steady improvement as the year progresses. Given record levels of cost inflation, we are focusing on pricing, cost savings, and productivity as levers to drive long-term margin and profitability expansion. As we highlighted on our last call, we have 2 rounds of price increases going into effect in the first half of 2022. Our first round of pricing went into effect in January. Given continued cost headwinds, we've announced to our retail and online retail partners a second phase of pricing actions on additional items in our portfolio, focused on select personal care, wipes, beauty, and diapers that go into effect at the end of Q2. In total, we expect our price increases from the first and second quarters to impact approximately 2/3 of our revenue base and benefit future margins by 375 basis points. We expect 2022 margins to be flat to slightly down versus prior year. Our margin outlook reflects current levels of cost inflation, but the environment remains volatile and subject to a high degree of uncertainty. We continue to monitor the cost environment and will take additional pricing if needed to offset further unanticipated increases. Considering all of these factors, we expect to achieve positive adjusted EBITDA in the back half of the year. In closing, I wanted to invite all of our shareholders to attend our virtual annual shareholder meeting scheduled for May 25th. With that, I'll turn the call over to the operator, and we look forward to answering any questions.
Thank you. As a reminder, to ask a question, you will need to press star 1 on your telephone. Again, that's star 1 on your touch-tone telephone to ask a question. To withdraw your question, press the pound key. Please stand by while we compile the Q&A roster. Our first question comes from the line of Dana Telsey of Telsey Group. Your line is open. Dana, please make sure your line isn't muted, and if you're in a speakerphone, lift your handset.
Oh, okay, yes, I think it was muted. Sorry about that. As you think about the guidance that you're giving for the remainder of the year, and you think about the price increases being taken, is it more than the mid-single digits? Is it ranging differently by category? And with the increased distribution channels, which are impressive in terms of where you're going into with Ulta, Walmart, how does that phase in? And what are you budgeting for an uptick in revenue from the expanded distribution channels, whether it's this year or as you anniversary next year? Thank you.
Or I'll start by taking the pricing question, and then we'll come back on the distribution question. So the first pricing that went into effect in January, again, both of these price increases will cover about 1/3 of our portfolio. So in total, by the end, of course, the second pricing going in at the end of Q2. So in total, we'll have taken mid to high single-digit increases on 2/3 of the portfolio. And that is across the entire portfolio. So it will cover diapers, personal care, wipes, as well as select beauty items as well. So kind of pretty robust. We do anticipate this pricing to benefit margin by about 300 basis points in 2022. Of course, it's going in over the course of the year on a full annualized basis. It would be closer to 400 basis points. And when we think about the impact on the pricing, we, of course, mentioned in our last call that we're keeping a really close eye on the elasticities and the impact on volume. You know, we have had the pricing out in the market for just roughly 90 days, and pretty much elasticities and impact on volume are right where we anticipated them to be. We are certainly hopeful that over time the consumer, that will rebound later in the year. And so we haven't built in significant revenue upside for the pricing. It's predominantly going to benefit our margin.
Yeah, I could add, hey Dana, it's Nick, concerning the distribution pickup. Everything's on target, as I referenced earlier on the call. As it pertains to Walmart, national distribution, broad footprint on our diapers, wipes, as well as our personal care business. The .com portion of that's going to hit in Q3, and then retail stores Q4. And then with Ulta, again, broad distribution against our skin business. It'll start to hit stores in Q3 also. So a real nice complement at Ulta. We've been with Ulta on the .com side of the business at Ulta.com now for a while, and just a testament to the strength of the business as we're now driving distribution in store. So pretty much right on target from a plan perspective on the distribution side.
Got it. And then just on supply chain with the constraints on inventory levels, how do you think about that pacing through the balance of the year? How you're thinking about supply chain?
Yeah, certainly we have on the biggest piece of our business, the diaper business, we really haven't been impacted by supply chain. We haven't been out of stock. We've been able to get regular supply on that. You'll have noted in Q1, we did actually expand our overall inventory position by about 10%. That was really to address longer lead times across the board, but predominantly in the wipes, where we are seeing what had previously been, shorter lead times coming from China, wipes representing less than 20% of our overall kind of business. We did want to take that into account, and we've had out of stocks, and we're impacted by out of stocks in Q1. We're now back in stock, but we expect to be continuing to see longer lead times and some supply chain constraints in that part of the business. The only other supply chain issue that we mentioned was really around some of the components that are coming out of China for the personal care and beauty business. Although those are manufactured here in North America, some of the components do come from China, and also some of the oils that were impacted more by conflict in Ukraine, such as sunflower oils and palm kernel oils. So as we think about supply chain, continue to be a little bit of a drag in the first half, and we're anticipating some intermittent out of stocks in some of the beauties. We continue to chase the components, but overall we feel we've been able to secure alternate sources of supply for many of those ingredients that are being impacted, and we don't anticipate, especially as we get into the back half of the year, we're feeling very good about our ability to deliver on the new distribution and new product innovation. Those are all, as we highlighted, on schedule and on time, as anticipated and built into our projections for the year.
Thank you.
Thank you, Dan.
Thank you. Our next question comes from Laura Champagne of Loop Capital. Your question, please.
Thanks for taking my question. It's about your digital marketing, which I think you mentioned that digital in part was weak because just the CAC was much higher. Do you anticipate that changing, or do you expect to spend up specifically on digital marketing in order to drive the growth you expect in the next few quarters?
Yeah, I'll talk first about what we're doing on the marketing, and then I'll talk about our additional digital initiatives. On the marketing front, there's two things we're doing. The first is really changing the way we're spending against digital. A great example of this is, we were able to refocus spend with our key digital partner really on the top items, and we were actually able to deliver higher sales, consumption data, sales on those items on lower spend. So we're changing the way and utilizing things like our Omni Analytics to really drive and spend digital in a more cost-effective way, given that we've seen such escalation in the cost structure there. The second piece we did is we're really shifting into retailer marketing. We had a great example in Q1 with our Oscar TV campaign, and we partnered with a major retail partner to really serve up those ads specifically to their customers through streaming TV. And we're able to see, and they were extremely pleased that they saw that drive specifically customers into their stores for the Honest product. So 2 efforts, just being much more thoughtful and utilizing our data and our tools to invest behind what's working in digital spend, and then really supporting retail and where the consumer is going. On the digital front, we talked in our last call about various initiatives really to optimize the shopping experience. The biggest thing that has gone live in Q1 that we wanted to highlight, given that 76% of traffic comes from mobile, we just implemented a new optimized design for honest.com, which actually is both for desktop and mobile. It's really a dynamic layout, content written. It allows for things like personalization and improved shopping cross-category. Coming up in the back half of the year, we have a rolling schedule of new improvements on honest.com. We'll be doing things in the back half of the year, like changing the way our subscription business works with new bundles and some more cross-category curation that we anticipate will launch in Q3. And then as we get farther in the year, things like loyalty, personalization, and other main features to really drive and improve. And our focus in digital, again, we know the headwinds are against us in digital. We're not the only ones experience this. We're really focused on driving conversion. So the traffic that is coming to our site, really ensuring that we make it as seamless as possible for our customers. But we do think, digital, of course, is here to stay, and we want to make those investments for the future. And we'll be coming back and talking about additional initiatives in 2023 as well.
Got it. So is it fair to summarize that cost to acquire a customer is expected to be reduced, but because of your own efforts to be more efficient and drive conversion, not necessarily because the market is coming to you?
Correct.
Got it.
Thank you. Our next question comes from Andrea Teixeira of JP Morgan. Your line is open.
Hey there, this is Drew Levine on for Andrea. Thank you for taking the questions. I wanted to circle back on the elasticity conversation. So just curious if it's kind of differing by channel or by category. You talked about the second price increase going in, I think at the end of 2Q. Are you modeling for the sort of levels of elasticity that you've seen thus far? Are you modeling for sort of more historical elasticities? And then just anything you're seeing, I guess, quarter to date in April and May, if there's been any sort of shift in things progressing, if consumers are trading down more, and just sort of like any changes, I guess, that you're seeing in the marketplace, or what gives you confidence that the elasticities are going to hold to your expectations?
Yeah, I'll start, and then I'll let Kelly kind of add, just based on the data that's out there in the marketplace. And if you take a look at IRI kind of MULO data over the latest kind of 12 weeks for the quarter, what we've seen is, take diapers, the price per count has gone up about roughly 9%, and the category's up roughly about 12.8%. Honest, during that same time period, our pricing has moved up about 5%, and our results were up about 22.5% during that time period. So what we're seeing, kind of based on our current plans, for example, with diapers, based on our elasticity assumptions, that we're seeing the consumer continue to pick Honest. When you look at the category, we're outperforming from a consumption perspective. And again, that's going head to head when you look at those consumption numbers versus the national players that are in the marketplace that are also reflecting price. So from that standpoint, that gives us conviction as it pertains to kind of the second round that we're also talking about, because again, some of those individual players have already passed through that pricing, and we're going to be following and be able to continue to maintain kind of our price gap relationships versus the rest of the marketplace. Kelly, you want to add anything else?
Yeah, no, given that the elasticity impact was what we've seen historically and also on our expectations, that is what we have built in for the second price increase, which is on a different set of products. The only thing I want to highlight, we've seen consistency across those elasticities, with the one exception of wipes. We did not see as much impact on unit volume, but we do think that that was partially due to not just ours, but not just Honest, but other wipes coming from China being kind of short on the shelf. So we think that that might be a little bit more noise. We'll be keeping a close eye on it. We're happy to come back and provide some additional color on our next call.
Great, thanks. And then I just wanted to ask about the shift to retail from digital. I think last quarter you may have said that for the year you're expecting digital to be down mid-single digit and retail up mid-single digit, if I have that right or not. But is that still the case? Are you seeing kind of acceleration in the shift relative to your expectations heading into the year? And so just anything there would be helpful as well. I think you moved past maybe the like toughest compare from a mix perspective on the channels. So curious thoughts there.
Yeah, no change. You're exactly right. Mid to high single digit decline in digital for the year, and a mid to high single digit increase for retail. So that's correct.
Thank you.
Thank you.
Thank you. Our next question comes from Laurent Grandet of Guggenheim. Your line is open.
Hey, good morning, everyone, and great to see you meeting your expectation in the quarter and reiterating your guide for the year. That's a good change. Okay, so two questions. The first is really about like to not shoot for the moon, but try to frame probably better the size of the upside for Walmart.com. But Walmart. So could you probably tell us a bit more about the number of SKUs you are planning to get? I mean, maybe the lineup versus Target. So trying to frame what the upside would be for you on Walmart and Ulta.
Well, clearly Walmart being the largest seller of the diapers, it is really a big potential for us. We will have broad-based distribution, but it's launching at the end of the year. And so this is really a 2023 play. And we will be on the shelf in store in diapers, wipes, as well as personal care. So, it's across our product categories. We'll be, as we get closer to launch date, we'll be providing more color on what the launch looks like, including launch support. But we're, again, as Nick highlighted earlier, we're pretty excited by the potential, particularly as it relates to creating more kind of geographic diversity for Honest and really getting into the South and Southeast, where things such as new births in the U.S., 42% of them are in the Southeast. We know that we're underpenetrated. Our ACV in the Southeast is the lowest of all the regions at roughly 20%. So that's certainly a big potential for us over time. And, certainly, Honest may not be a fit for all Walmart stores, but we're pretty excited that we expect to get broad-based distribution nationally with Walmart. Okay.
Thanks. And I'd also like to understand probably the potential for the supplement, range at GNC. I saw, they were also, doing a press release this morning mentioning the launch of Honest brands. So I'd like to understand the size of it. If you can help us, and also as well for this international expansion in Asia with Superordinary. How should we think about this? And what's the resource you are probably willing to allocate for those initiatives?
Yeah, I'll give you some color here, Laurent. Number one, as it pertains to the supplements, I'd start with number one, the consumer has always given us the credibility around better for you from a lifestyle perspective to kind of play in this space from a brand perspective. And we've been in this category with our prenatal vitamin business. It's a great acquisition tool as you think of .com and digital in this space. The way we've identified this area right now is really around kind of holistic health and wellness, specifically around not traditional vitamins. It's really around sleep, around stress, immunity, around hair. We believe we've got a right to win because from a formulation perspective, we've got proprietary blends that are unique in the market. For example, if you look at sleep, a lot of blends out there talk about melatonin. Our product does not have things like melatonin. It's got a different magnesium-based proprietary blend. So we believe that this gives us a nice foray into a space that also will benefit us as we think of our .com business, as we think of subscription and point of entry with new consumers. So we like that. I would, though, highlight the fact that this isn't a major, huge bet. We've been in the space before. We're going to be methodical about the distribution, getting the credibility with a GNC that's the preeminent player in the space, but then also be able to drive it within our .com offering. So that's kind of the supplement kind of takeaway. The Superordinary piece, obviously Superordinary, they're the premier kind of partner when you look at beauty brands that get introduced in China. We've partnered with them specifically to introduce our Honest Beauty business in China with a Tmall execution. They've got a history with a variety of brands that you can look at that they've been able to scale in a very significant way. We want to make sure that from a prioritization resource standpoint that we've partnered with a preeminent player there because they're going to be managing that part of the business. So then obviously the team here is going to be obviously prioritizing what we have in front of us as it pertains to North America as well as the European business that we've been driving with Douglas and some of our other partners. But again, these are areas that from a strategic perspective, as we talk about Honest, from a global brand perspective, we're going to be methodical introductions around one, adjacencies, which is the supplement component, and then two, the geography piece as it pertains to beauty and in Asia.
Thank you, guys. I'll pass it down. Thanks.
Thanks, Laurent.
Thank you. Our next question comes from John Anderson of William Blair. Please go ahead.
Hey, good afternoon. Thanks. First question, just to follow up on, I guess, Laurent's question on supplements. I may have missed it, but could you talk about the timing of the launch? And then could you talk a little bit about your broader plans for the household and wellness segment?
Yeah, I would say, John, from a supplements perspective, you're going to start to see those start to show up this quarter within GNC in the market, and then obviously Honest.com is the second component of that. And then as it pertains to household and obviously the wellness piece, this wellness element that we talk about is a key play for us because as we think of Honest from a solution set, innovation perspective, we've always identified wellness around kind of what you put in your body, what goes on your skin, and what can impact you around you from an environment perspective. And again, when we say we're not talking about food specifically, but areas like this around supplements and being in a position to start to address really some of these key consumer dissatisfiers that are in the market as it pertains to formulations that can address the sleep, the stress, the immunity, the hair growth, et cetera. And it also is a good precursor as you think of evolution around innovation in the future as we talk about beauty from within, as you talk about your health also from inside out. So that's kind of another element as we think of innovation and our cadence moving forward. The second piece around the household specifically, obviously, sanitization continues to be a component of our offering as well as our household cleaning lineup that we currently have. And we're going to continue to look at innovation that we work on to be differentiated within the marketplace in that space. But currently, we're satisfied on the household side with the product offerings that we have.
Thanks. That's helpful. As you have a lot of new products, new distribution as the year proceeds. Do you have any plans or needs to heavy up on marketing spending throughout the year in order to support these launches, either some of the mid-year developments or the Walmart national rollout? Which I guess is happening later in the year?
Yeah, of course, those programs will be supported. Like all of our other retail partners, we will open up work cooperatively with them, utilize our kind of content commerce, community commerce strategy to build content for their customers. But as we look at our overall marketing spend, we did mention that we expect to be in the mid-teens. We think that's the right level to be able to support both the retail distribution growth that we have planned for the year, which is, probably, more of a 2023 than a 2022. But as we launch those, the biggest focus will be execution and landing both our new product innovation and distribution, getting those on time into the stores. And as we think about marketing longer term, we have historically said 15 to 17%, and we will scale that as needed, particularly to support specific product launches, probably more than distribution launches.
Okay, that's great. A couple of housekeeping questions. Kelly, you mentioned that, I think you said margins on the year are expected to be flattish to slightly down. Were you referring to gross margins when you said that?
I was speaking to gross margin. That's correct.
Okay.
Which is slightly different than what we communicated in our last call. You'll recall that we said flat. Now, just based on some of the escalation we've seen in some things like the oils and some of the other components, driven predominantly by the conflict in Ukraine, we are seeing some slightly higher costs come through than we did last time we spoke. And the one thing I want to mention, just as you think about going over the course of the year, each quarter will be progressively better as it relates to revenue, gross margin, as well as adjusted EBITDA, so progressively over the quarters. And the one thing we wanted to highlight, particularly for Q2, since our round 2 pricing is not going to be until the end of Q2, some of that margin pressure in particular is hitting Q2.
Yeah, that's understandable. And that kind of gets to my second question on EBITDA. You mentioned EBITDA positivity in the second half of the year. Do you mean the second half in aggregate or, in Q3 and Q4?
We said in aggregate.
Okay.
For the second half.
If I can squeeze one broader question in, as it sounds like, as you're shifting more emphasis to retail and more marketing dollars to retail, how do you think about that in terms of affecting your ability to acquire new households or consumers? And do you lose something in the lack of, first-party data, maybe that you acquire, or your ability to cross-sell using some of the tools you use on honest.com? Or do you just see this as a great opportunity to try and bring new users into the franchise and, perhaps then kind of, usher them into the digital side of the business as well? Thanks.
Yeah, it's a great question, John. I think for us, what's really important is, and if you recall, we have limited amount of partners from a retail perspective that we work with. So our ability to work with them on their card data, their loyalty programs, is a precursor to where we invest our shopper marketing dollars. So there has to be a connection around the marketing that's being done with those partners on the digital side to be able to drive acquisition, to be able to drive trade up and incrementality across category, as well as the support that goes then in with those partners that go beyond a specific category. So if it's the diaper business, also how we connect our wipes business and our personal care business. So it's really around driving, number one, awareness and being able to drive a shopper and make them that honest shopper. And then two, the marketing that we are doing is cross-category oriented that takes that consumer to that second or third item, both for the baby business as well as our beauty business as we talk about different solution sets around skin as well as color. So it's kind of a twofer for us, and we think it can benefit us. And we're seeing it when you look at the consumption data that I referenced earlier, when you look at, over the last 12 weeks, how our business, is performing and outpacing the category in both, for example, in diapers, as well as in wipes, as well as in personal care. So that gives us, confidence that, we're definitely driving not only the trade up, but we're also driving incrementality.
Great. Thanks.
Thank you. Our next question comes from Steph Wessink of Jefferies. Your line is open.
Hi, everyone. I have a couple of technical questions, so my apologies. I just want to go back to, Kelly, your response to a prior question. The guidance is in aggregate to grow mid-single digits, or each quarter you expect to grow mid-single digits?
It's in aggregate.
Okay, so if we use that as a base, I think that would imply about $12 million or so of growth year over year. Maybe help us think about the contribution of price, which I think you mentioned was mid to upper mid-single digits, the new distribution, maybe how much conservatism you're building in to that assumption, just given the timing of that new distribution. And then as a related question, it would seem like your legacy distribution might be down. So just trying to understand a little bit of how we kind of bridge the total amount of growth, given the distribution you're gaining, the pricing that you're putting into place relative to the performance of the legacy distribution. Thank you.
Thank you, Steph. It's a good question. I think when you think about the new distribution, we laid out a couple points of growth in 2022 on our last call, also from innovation as well. I think the headwinds, that we're seeing as we think about the digital decline in traffic, really being kind of offset by the new distribution and innovation. I think we are seeing growth as we've seen with the track data. Our legacy distribution is actually seeing great growth in the retail side. Where we're really seeing the headwinds, as we mentioned in our last call, is we have a rotational program that we've landed for the past 2 years that we are not comping in 2022. It was a very successful program in the back half of 2021, and that is the largest single headwind that we have. That program, in total, is kind of a decline on the year-over-year business. So it's certainly we've got a good base business with them, and we periodically have had success, and certainly over the last few years have had great success getting rotational programs in. But that's really offsetting the strong growth that we're really seeing with our legacy retail partners in the track data. The pricing
that's very helpful.
The only thing I wanted to mention on the pricing is because we are kind of assuming, especially this is the first price increase that honest consumers have ever seen from us. We did take a conservative approach in elasticity. So far that's tracking versus our expectations. While we're hopeful that over time those unit velocities will come back, we did not assume a step up in overall revenue in any significant way as a result of the pricing. That was really a margin improvement strategy.
Thanks, Kelly. That was my final question, so you got it. Thanks so much.
Thank you so much.
Thank you. Our next question comes from Brian Spillane of Bank of America. Your line is open.
All right. Thanks, operator. Good morning, everyone. Or good afternoon, I should say, here at least. Just a couple of questions. First, Kelly, as we think about the more of a shift in the marketing mix or the sort of demand spend going from digital to supporting brick and mortar retail, is there any change in the geography of the P&L of where those expenses will be sort of realized? So I guess what I'm thinking is, will there be more that is more like trade spend above the revenue line versus being captured in SG&A? Just trying to understand if there's going to be any kind of shift in where we'd recognize that spend.
Yeah, there won't be meaning there will not be a shift. There is a shift, but it's already been reflected in our outlook.
So the revenue outlook includes some spending above the net revenue line.
It does. That's
okay.
Correct.
Okay. Can you give us any sort of idea in terms of just size, just how much of the spend is shifting, or how material that is?
So we don't break down the components really by by channel. Overall, I think the highlight to say is that we are shifting from kind of a year in which kind of volume was slightly weighted towards digital to moving towards being slightly weighted towards retail. we've always said, in this 50-50 scenario, there'll be years where there'll be a little stronger retail. You can expect the strength in retail as we roll out some distribution, but it's going to be more like a 45-55, not a really big departure from what you've seen from us in the past. And therefore, we're not calling out, and because it's really not material in nature, the shift.
Okay, all right, that's helpful. Thank you. And then in the queue, there's a mention about two co-manufacturers who, I guess, inflation triggered a renegotiation of the rates, I guess. Can you give us a sense of just how that impacted your inflation assumptions, and then should we be? Is there a possibility that maybe more of your co-manufacturers might be in that same position, and we may see more of that over the course of the year?
Yeah, so we have about 80% of our overall product cost is with 3 manufacturers, and those are negotiated in advance. So typically we have complete line of sight to kind of what our pricing structure looks like for the year. And in 2021, their contracts do have escalation if there are 2 quarters in a row of input cost escalation above hurdles that are within the contract. It gets triggered to renegotiate. And so that actually happened already and was built into the outlook that we provided to you when we talked just 7 weeks ago. And so we have clear line of sight kind of with those manufacturers. We've agreed on pricing for 2022. And we don't, while certainly, there would need to be a very significant escalation above where prices are now for an extended period of time for that to trigger, and it would trigger towards the end of the year. And so, we have pretty good confidence, perhaps versus maybe other people's out there, other companies out there who are getting surprised by these. I think we have pretty good overall visibility to what our cost structure is for the year.
Oh, that's great. Okay, thank you.
Thank you.
All right, so for those of you probably came here from the timestamp if you didn't want to see all that, but we just basically listened to the entirety of their earnings call, even the Q&A section. I thought some of the analysts were absolutely hilarious. The first one just didn't know how to use the phone, and at one point, one of them, I forget his name, but the one with the accent, the strong accent, he was kind of dissing them a little bit. But all right, so we have a lot to actually discuss or decipher. So basically, some of the key risks I'll talk about that towards the end. But I will say this. The most exciting part of this business for me is actually their beauty segment. I'm not actually too excited about the diaper. The diaper segment is very competitive, and you guys probably saw me bringing up some diaper products and comparing prices, but essentially kind of evens out that they're about 10 to 15% more expensive in some cases on the diapers, depending on if you look at an equivalent diaper variant from competitors like Huggies. So I grabbed, like the natural variant of Huggies, the hypoallergenic one, and it's still more expensive to go with an Honest. So it is a lot about the branding. I also want to note that Huggies and Pampers, right? Huggies is owned by Kimberly-Clark, Pampers by Procter & Gamble. These are very large enterprises. So, to compete with them is going to be difficult, but it's doable, not impossible. Now, we saw some gross margin pressure, and so the CFO actually was highlighting that there's about a fixed 4%. So she says 400 basis points. For those of you who don't know, that's 4%, was actually because of fixed cost developments or deleveraging actually, and transportation and freight was one of the instances that kind of caused that increase or that decline in gross margins. And so gross margins are projected to be flat, maybe slightly up, but they're also going to be raising prices to try to actually increase it by 400 basis points. They're having a 2-stage price increase, and when they said the elasticity, that's going back to your economics lessons if you ever took economics. So they have to, when you do price changes in a company, you have to measure the elasticity of the product, and that from there you can estimate, you create like a demand function, and you can estimate the effect the price increase will have on the quantity demanded. So basically what they're trying to say is they don't think the price increases will have that drastic an effect, and it should be a net positive to the company. They used terms for adjusted EBITDA. So they have negative EBITDA right now. They do expect to have adjusted EBITDA of break even for the second part of this year. So we'll keep an eye out for that if that ever happens. So they reaffirmed 2022 outlook. So that's again what the analyst was kind of like dissing them for. It's like, well, finally you guys are sticking to your outlooks and stuff. But we do see a decline in growth. They have legacy beauty products that are kind of not doing so well. Well, specifically the desanitizing products, because it's all in one category. They do expect to restore growth through integration in Walmart. So, and also talking about supply chain issues that are occurring within the company. So supply chain issues extend towards the end. And I love that last analyst from Bank of America because he asked an interesting question that I would have had. So they actually did experience some trouble with the manufacturing. You guys didn't hear it. I'll just explain it. So they had to renegotiate their contracts with the manufacturing provider. So they don't actually manufacture their own products. They have a third party doing it. That's all well and good. That allows them to kind of be light right now, but maybe in the future they can manufacture their own products. I don't know. Whatever they end up deciding, hopefully they do what's good for them. But yeah, they had to renegotiate the contracts because in the previous contracts, there was a clauses of if there were certain thresholds passed, I think it was 2 thresholds, they said, for input cost increases, that it would trigger a renegotiation of the contract. It happened and it increased their costs. So that kind of contributed again towards that gross margin kind of coming down. Now, the switch to from digital to retail channels, the Bank of America analyst was asking about how that's going to affect their above the net revenue line cost. So basically when they're negotiating with a retailer, they have to sell the product to them and then they sell it to the customer, the end customer. So how that's going to affect them on above the line, because when you have the digital sales channel, they control the full thing. And another analyst was asking how that might affect their ability to gather data, because when you go to their website, that's where they can actually see everything as regarding to the relationship with the customer. They control every aspect within that relationship. When they sell it to, for example, let's say Target or Amazon, Amazon gets that data, and then Amazon is the one having that relationship with you. They only have a relationship with you to the extent of the brand and the product itself, but not the actual sale and delivery of the product. So we'll have to see and pay attention. If you're invested in this company, you want to pay attention to the pricing action regarding how they're able to pass on costs to consumers. Will consumers take that increase in price, or will they not? Again, we've heard a lot of supply chain issues. We did see skincare actually decline by, it made up 31% of the sales volume. It declined by about 19%. And again, mainly driven by that beauty reshaping that they're going on. But I think beauty has the greatest potential. I was actually looking at data prior to this, and I was actually coming to the call already more interested in the beauty rather than the diaper. Again, I think the diaper is very competitive. There's room to grow there. There's room to grow in the wipes as well. They have a specific niche category in the more expensive side. Again, but it's going to be very cutthroat. I don't really like that business too much. The beauty section, women will apparently pay up for beauty. Now, I don't know if they're going to compete in the ultra luxury part of beauty, because that's already dominated by a lot of other companies. They can compete there, but they might be more competing against kind of your basic products that you might want to pay up just a little bit for it. Just a little bit for it. And in that case, they're actually not that expensive from what I'm actually reading. So I was actually doing a little bit of research, and they're pretty cost competitive when it comes to the beauty products, okay? And I know that diapers, they are more expensive, and they are kind of open about that. That's what they're saying. They target a specific category of parent that wants to spend that extra amount on their child. For, let's say they are allergic, because, if you don't have an allergic child, then some of these products are kind of useless. But for example, Huggies has a Huggies Natural. And in that sense, it's basically very competitive with the Honest brand. Like I said, it's not going to take much for these bigger brands to really make a competitive product. It's in the beauties part that branding starts to become really, really important. and the quality of the ingredients actually does make a difference. So, some studies have been shown that women are caring more and more and more about their skincare quality products because, for example, if you put poor quality products on your skin does tend to absorb a lot of the things we put on it. And so with more natural, quote unquote, ingredients, and it's not even, by the way, let me just be clear, if you don't believe in the whole natural thing, think of it in the sense of marketing. If the customer cares, then it does matter as a business. But from what I'm gathering, the ingredient quality is actually pretty good. So it's not just taking their word. I'm taking third parties' word for that. But yeah, that's something to note. And as far as growth for this company, they are telling us that they're going to grow in the later half of this year, that they're kind of tackling that problem from having so much demand pulled forward. So we have to kind of brush that aside and really look at that. They have supply chain issues due to the conflict going on in Ukraine. So, they're actually missing out on some oils. Not missing out, but the costs have risen drastically for them. So that's hurting them in particularly the skincare product lines and in other products as well. But the Walmart launch is going to be interesting because we can kind of gather to see. Now, did you guys pay attention, or maybe you guys didn't see that part, but there was a part where one analyst asked about the customer base at Walmart versus Target. And this guy said, or the CEO, I think, was the one who responded to that question, was it depends on the area, right? Because like, for example, anecdotally, I have a Walmart by my house. I've heard from other people that Walmarts are terribly kept. The one by my house is very nice. It's a very nice Walmart. So I would actually go to that Walmart, and it's a very well-kept Walmart. It's indistinguishable from Target, to be honest, in terms of the quality, the aisle space between each aisle. But then I also went and visited a friend once at a different Walmart, and then I went to that Walmart, and I was like, wow, this is incredible. It's so different from the Walmart by my house. So it does matter where they're going to really place those products. They're obviously going to place those products strategically where they believe most of their customer base might potentially be there. In this case, it might be where people are willing to pay about 33 cents per diaper, which, by the way, the Huggies variant was about 30 cents per diaper. So about 10% cheaper. 10% adds up, by the way. Okay, it adds up over time. If you think about how many diapers a family will go through, that begins to add up quite drastically over the course of many days. And then Pampers was actually 32 cents. So Pampers actually was more expensive. And I went on Target. So I actually checked out the prices at Target. Pampers was 32 cents. Honest was 33 cents. Huggies was 30 cents. But this was like the special Pampers. So I'm not comparing regular Pampers. And then you also have the white label variants, which is still, by the way, that's still going to be Kimberly-Clark or even Procter & Gamble, but they might produce the white label variants of their own products. And so you might see that at great value for Walmart. Every store will have their own. So remember, the proposition that these companies have to make, and remember, let's also kind of take a step back. Honest does not produce their own, so they don't have that vertical integration you might think. They're basically a brand. They're slapping their brand onto the products and then selling it to the consumer. Now they have a lot of, and this is the part where they actually focus on proprietary ingredients mix for their beauty care products. And again, like I said, I think that's the most interesting part of this business for me, in my opinion. Okay, I would be actually excited to keep track of that business line, and I would not be surprised if they become successful in that business line. Will it be difficult? Yes, but if they succeed in that aspect, I see good things for this company, actually. If they just focus only on the diaper, it's very cutthroat. I don't know if they're going to end up being very successful. But that's my opinion, okay? I think they could be successful in one category and then be moderately successful in another category. But one category, they only need one of these categories to really work out for them to be able to kind of expand into other categories. And I think there is space for kind of a newer up-and-coming brand. One advantage you have when you're working or dealing with a smaller company is mobility or ability to adapt quickly. Now, you might also consider this fact, that because we are going through a turbulent time it might make things a little bit more difficult in the short term for this company to acquire new customers, because they have to make the value proposition case to these new customers saying, hey, you will be willing to pay up for these diapers because, the products, the ingredients is much better. And I know those diapers are cheaper, but you should buy ours instead. They have to make that value proposition. That's why I'm more excited about the beauty, because in beauty, it does appear that that value proposition is easier to make with women than, for example, making the case with, let's say, diapers or baby wipes. It can be made. There is a market for it, but it's not as easy as something like beauty. If you actually take a look, there's obviously varying brands within beauty, but you can see, for example, there's what we call the drugstore beauty brands, and then there's what we call, I forget the name for the other one, but the more expensive variants, right? A lot of them owned by, Estee Lauder, for example, is a good example of a beauty company that has some, for lack of a better term, bougie brands, okay? So women are willing to pay up for that kind of stuff. And if you can tell them, hey, this one won't be as bad for your skin as the other one, they might consider that. And it's easier to make that value proposition. Okay. But that is still a smaller part of their business. And so right now they live and die by their sales in diapers. Again, skin and beauty is also very competitive. So they're dealing in a lot of competitive industries. This doesn't mean that they're destined to fail. It does mean that they have an uphill battle, and they're going to have to be creative in how they solve a lot of these issues. Now, they did mention, by the way, that they have not increased the price as much as the category. And I actually was seeing this when I was actually surprised to see that the price gap between regular diapers, such as the Huggies and Pampers brands, have kind of risen to be closer to Honest. And Honest, it hasn't risen as much. And they mentioned this in the call. So that's why they believe that they can increase further and kind of regain that gap. That's the wording they used, I believe. They said, we can regain the gap between us and the category. So that just basically means they believe they have more room to raise the price. And so that's part of their double planned price increases throughout the year. Okay, so I think, for example, this aspect of the company is, it's something to keep an eye on. It's something to really keep an eye on. Diapers still make up about 60%. It was a little bit down. And again, I think that going to retailers is going to be more successful than maintaining a simply or purely online presence, right? And they're not purely online. They're omni-channel. But I think the retail is going to have more success. And as they build that brand or that recognition with the consumer, they can eventually try to, be kind of platform agnostic, okay? But I think that they're making the right move, in my personal opinion, at the size that they're at, to focus on growing in the retail. So if we take a look at this company versus something like a Tattooed Chef, I think this company is better, has more opportunity than something like Tattooed Chef, which is another stock that we talked about here. And, these are part of the YouTube stock. So I'd say this is a better YouTube stock than something like Tattooed Chef. And I'm just kind of discussing it from the perspective of potentiality. So for me at the present moment, it appears that it's mainly more of a speculation than anything, if I were to participate in it. But there are some other key aspects I want to discuss, and it's going to be what was said before about this company on Capital Mindset Show. Okay, so just real quick, taking you here, when there was a title of this video was "Let's Be Honest with Ourselves." Haha, very clever. And so we see here, and let me actually make this larger. March 27, 2022 was the post of this video, or when this video was posted. And the scenarios outlined here, the price was about $4.68, so basically $5. But the scenarios outlined here kind of spelled a different scenario, and I think I was a little bit too generous on the dilution amounts. But honestly, pun intended, I think that the dilution might be a little bit greater, hopefully not. And the growth rates over time are hopefully going to be reflected between the 20 and 13%. I do still think, I reaffirm that belief, that's actually where the growth rate will end up being. And, that's a wide range, I know. But yes, so at the time, it wasn't at the proper value. I'd say right now, if one believes that to be the case, which I'll take you guys through the same evaluation process now, which I'll just take us there now. All right, so I took us right over to the model just to plug it in because we'll keep this part brief. But essentially, I kind of stick by what I said in the original video that I just showed you guys. So I think that, you know, if it's come to that speculation, and to be honest, this is the mystery right here, the dilution amount. I don't know how much they will dilute, but I probably do expect some form of dilution. I got a comment that was really interesting on the Tattooed Chef video saying that the individual did not understand why, if, you know, prediction of some sort of profitability, why the company would dilute. And I think, I don't know, we've gone over so many different companies on the channel that are currently profitable and still dilute. So that person, I guess, did not understand that. It's newer to the markets. So that level of confusion, I mean, I hope, you know, our viewers here, they don't get confused like that. But regardless, so taking a look at Honest, I think they could dilute by more, maybe less, probably more. And yeah, if you're kind of looking for that decent margin of safety, that's kind of like my points previously still stand. I think that I'm being kind of generous with the growth rates, but I'm saying they're operating from a small base. So we have to understand that too. So it is possible. And this is a much cheaper company than originally, right? This was $1 billion plus company. Now there's also the potential that, you know, let me just tell you, I think that they're in a much dire strait now rather than before, because now if they dilute, the cost is going to be much more than it was, you know, obviously when they were above $1 billion in market cap. So the actual cost of that equity issuance is going to be greater here and now. Now, kind of culminating with all the risks that we kind of discussed previously, I think that this, for me, if I were to participate, would be in the speculative side of the portfolio. I think that it has a chance, it has potential, way more than previous companies or other YouTube stocks we've covered in the past. It has at least a business model that has been replicated in the past and has shown to be successful. It's just maybe they're concentrating too much on very competitive categories at the present moment. So yeah, if they grow tremendously, oh, and by the way, we are assuming that they achieve profitability or full level profitability in about 6 years or in year 6 from now, which constitutes around a 10%. I kind of penciled out a 10%, so it works its way out to that based upon the growth rate assumptions that I provided. And so, you know, this is a difficult one. This is a much more difficult one to kind of really put a grasp on. So I'd say that at the present moment, it is not as badly priced as previously, or as badly priced as what it was originally talked about, because there's a video I made even earlier than the one I just showed you. And I'll pull it up, because why not? All right, so this is real quick. So this one was posted on October 2nd, 2021. The price was around $10. The conclusion there was it was not worth the risk at the time. You had to assume a lot of growth in order to make it justifiable, and growth that did not manifest, turns out. Also, we did talk about the problems or the potential for inflation being something that hurt. What did we hear in the earnings call today? A lot of concerns about inflation. Well, that kind of have already manifested themselves. So the price here is significantly different. We are down about 70% from that video. So, and then, you know, we're still down a decent amount from the other video that I showed you. So the company this price has de-risked a lot. It might not have de-risked everything. The price is better. And I hope you guys can see that I can change my mind, or I can change my tone if the facts change. I'm not set in stone on this company's terrible, period. It depends. And I will always try to be as objective as possible. So I don't think after this video especially, I think maybe some of you who've seen those videos and said, well, he just hates that company. Now you're seeing my tone change, okay? So it's not that it's a terrible value now. It's kind of like in that, now it's not too obvious whether or not it's overvalued or undervalued. Before, it was more obvious that it was overvalued. Now, not so much, okay? So if you think it's going to go much lower from here, you're basically pricing it for bankruptcy. So I think here, you know, heck, I may put a speculative position into this company. it would be speculative in nature, and that's about it. Because all it has is potential. It has raw potential and not so much execution at the present moment. They have a huge reliance on Jessica Alba's, you could say, clout. So they're relying on a lot of Jessica Alba's clout presently to kind of succeed in their categories, which is a good strategy. It's a viable strategy, but can it succeed over the long periods of time? Will the consumer base react in the way that they think it will? I don't know. So all these are questions, and the growth rate assumptions, I would try to be as conservative as possible within those growth rate assumptions. So let's actually make an adjustment here and kind of pencil out what do I have to assume. And I still think I'm going to give them 6 years to achieve that. I think that's a good enough time. And based on what I've seen or what I've heard from them in previous reports and kind of seen the kind of more or less the trajectory, they're already trying to say we're going to achieve operating income positivity like this year. Whether or not they can achieve it in 6 years in terms of full profitability or cash flow positive metrics in that time frame, if they don't achieve it then geez, man, I don't know what to tell you. So that it has to go into the speculative bucket. It has to, okay? Out of responsibility for my own wealth. I would not do anything other than that. So let's see, 17%. It's close to like a 17, 16. So between 16 and 17% is what you'd have to achieve or assume. And I think that's doable by this company. Now, if I were to say, for example, a 20%, and so increasing that margin of safety, I do have to assume that they are going to grow at about 24%, which again is doable because of the small base that they're starting from. But, can they achieve it, right? If I want a greater margin of safety. So I think for me, 15% is enough if I want to assume about a 2% share dilution. Now, that is the biggest risk, the share dilution. Frankly, this company could always just go bankrupt. So, but yeah. So that's pretty much what's interesting. Okay, and one more comment, because I wanted to comment this real quick on the from the AMD video. So some of you were looking at the PE and price to free cash flow. I stated verbally that PE was not the PE. I stated verbally in that video. I went over it, and I know I didn't put timestamps in the video, so that oftentimes is my fault for that. But I stated verbally that the forward prices were, I think was like, the forward EPS was like $4.40 or something. I said that. And just taking a look at this one right here, I wouldn't go over these per se, because it does depend on how the data has been reported and how it's pulling it through. So in this instance, I think it's pulling in trailing 12 months, but it doesn't pertain to this up here. Those are more, they're like quick glance statistics. I don't really utilize them too often because, anyone can pull a PE. You can pull it up on Google. It's whatever. I don't really focus, or, it's not optimized presently because it's not something I use every day. So it's not like fully optimized to the best of its ability. And same with like the dividend one. It's not optimized. It needs work on my part to kind of optimize it. But yeah, I'm working actually on the back end to improve how it's pulling some data. But again, there's always improvements I add here and there, always making some improvements. Like, for example, I've just been so busy with work, I haven't even redone these metrics to automatically calculate them. So they're just kind of empty. It's only calculating one thing, debt or equity heavy. It's calculating that, but it's not calculating the C Corp metrics of estimated WACC, dilution accretion, or COCR. It's not calculating any of that. But yeah, that's just some quick, I guess, housekeeping there. And so I think it's de-risked significantly relative to where it was before. I could see me adding like a very small speculative position. No promises there. I haven't really made a decision on that yet, but the only thing I'm interested or really excited, if I was excited about this company, would be the beauty aspect. I think that has the most potential, but the diapers and stuff, I don't really like that too much. And right now, that's the majority of their business. Making this a core holding, I think, would be, for me. Now, I don't know about you guys, because you guys can do whatever you want, but for me, I would think it would be pretty irresponsible, because for me, it's just mostly potential. So that still hasn't changed. But, as the prices do change, my opinion can adjust accordingly. And again, this is a better company, I think, has better prospects than something that isn't like a frozen food category company. So yeah. All right, guys, on that note, thank you guys so much for watching. If you found value in this video, go ahead and feel free to leave a like. Let me know down in the comments section if you made it to the end of this video. I have a question for you. Do you like videos that are like this, where I have the earnings call in the beginning of the video, and then I go over some of my thoughts on the earnings call? You guys get to see kind of what it is I'm looking at during the earnings call. I may or may not pause the video during that time to say anything, but most of the time it's just for me to listen to it, the whole thing. You guys can get a chance to listen to it too, and then if you guys want to skip over that part, I'm going to put the timestamps, obviously, to skip over it. But yeah, just let me know what you guys think, and I'll see if I do a video like this kind again, or I don't do anymore. By the way, if you don't want me to do videos like this again, say that as well, so I can get a better gauge of what the audience feels. All right, guys, on that note, thank you guys so much for watching. So see you on the next one. Bye.